Hello and welcome to Credit Shift News and Update. This week I'm Paul Sweeney, co-founder and chief strategy officer here at Webio. I will be just coming to you today on my own. So I will be going through the recent stories, events and reports and trends from the credit industry. So let's dive into some of the details. In general industry news, the headline news is that the UK officially ended 2023 in a recession. It is generally not expected to be a deep and long recession. However, the news that inflation is running at 4% will be good news for policymakers who have set a target of getting inflation back down to 2%. While inflation is coming down and the economy isn't growing, it would seem that pressure for interest rates to come down will mount as the cost of borrowing weighs heavily on both businesses and individuals. UK Finance has released its latest credit card spending data for November 2023, highlighting that there were 396.3 million credit card transactions. That's 6.4% more than in November 2022. The total spend of 20.9 billion was 6.2% higher than the same time the previous year. The figures showed that there were 2.21 billion debit card transactions in November, and that's a 2.6% increase over the same time the previous year. Contactless payments accounted for 61% of all credit card and 75% of all debit card transactions. In another snippet of news, MasterCard says tokenization improves approval rates by 3 to 6 points. This kind of convenience may be one of the reasons why credit cards continue to gain ground, eating into the cash transactions sector. Combined scheme payments volumes in Europe rose by 12% to 1,150 billion in Q4 2023, according to the latest financial reports from Visa and MasterCard. With nominal GDP growing at around 5%, this shows the cards are still taking significant share from cash. Moving on to FinTech, Buy Now, Pay Later, AI and related news. Over at Credit Strategy, it's been reported that most of the attendees at its private roundtable were keeping their forbearance strategies largely unchanged in the last 6 months, and really haven't changed it all that much in the last 12 months, with only 24% of those in attendance making changes. One of the reasons put forth as to why these extra forbearances continue to be possible was that more sophisticated digital messaging was making it easier to both reach out to customers and for them to self-serve over digital. Examples of using the new digital capabilities range from enabling customers to use chatbots to sending out questionnaires asking customers if they're nervous about the cost of living increases, a soft signal that they might need some outreach. This week, I have noticed some announcements in the industry that are starting to focus on the downstream benefits of better coordination with the end customer. Some solution providers in the open banking space are advertising variable recurring payments. The twist, though, is that by moving the payment date to be on a date where the customer can more afford it, the customer ultimately makes a fewer number of total repayments, resulting in shorter loans, resulting in less interest being paid. Many people rely on benefit payments, work part-time, or are freelancers. When combined with open banking permissions, the creditor or DCA could see when these payments came into the account, and something like a public assistance benefit payment being made, or the ability to have variable payments actually makes a difference here. On the other hand, many people need to have control over all the money that comes into and out of their accounts. And in that case, having a variable payment of any sort in their budget may be undesirable. If it can be shown that being on a variable recurring payment plan could save you money, I think it might even become a duty of care issue to make customers aware of the costs of various payment methods and various payment schedules. I really look forward to seeing some specific savings being made here, such as direct debit failure reduction, a reduction in the number of payments, and reduction in the amount of interest paid, etc. and I look forward to seeing those numbers come through in future research. Monzo has announced it passed the milestone of 9 million consumers and 380,000 business accounts, making it number 7 by retail customer base. The vast majority of growth came from word-of-mouth marketing. This compares to Revolut with 6.8 million UK users of 35 million total, and Starling with 3.6 million. The most profitable customer base is the elderly customer. The large banks have a cohort of profitable elderly customers, but they're not winning the younger cohorts. They will continue to erode market share. I remember one of our early credit shift interviews with Sean O'Toole saying that one of his early lessons at American Express was to win the young consumers because people don't tend to move once they have made a decision around who to bank with. So things looking good for the new banks in that respect. In the next section, we look at recent reports that have caught our attention that may be of interest to you in your strategic review process, or to bring to your attention issues we feel could impinge on your strategic plans. We are zooming up to the 30,000 foot view this week for a change. I was researching pay-by-bank trends, thinking that maybe there was some new reports worth reviewing, and I came across this awesome Substack. I'll have the link in the show notes. What emerged was a kind of cross-pollination between distributed ledger, large language model AI, and FinTech in general. LLMs, something we believe will be central to not only all FinTech but all companies, currently operates on the principle of embeddings and tokens. We all understand the concept of credit card tokenization, but identity solutions also use tokens. Thus the author's idea of token tech. For users and merchants, the obvious benefit is more security. The less obvious benefit is enabling new use cases that weren't possible before. This could be as simple as paying with your phone in store or enabling pay by bank with one click. The more complex use cases are still emerging, but there's a race to grab market share with those tokens and payment flows. This race will create winners and losers. So tokens create network effects for the people and groups controlling the dominant standard and capturing the economic value. And this is why the US Department of Justice has investigated the Visa and MasterCard token pricing closely. The writer makes the assessment that the winners on this token tech area would dominate existing payment flows, win new payment flow volumes, i.e. pay by bank machine to machine, own digital identity to unlock new secure transactions, unlock new experience with passkeys, unlock new experiences with asset ownership and transfer. Now, incumbents have never had a bigger opportunity and threat to their market position. Banks, card networks, big tech companies, payment companies, and open banking providers are all in the mix. To quote the author, the revolution will be tokenized. It is a really different lens on the industry that has been to date framed in terms of delayering or verticalization. Maybe thinking in terms of tokens, token handling, who's handling the exchange of tokens, etc., offers a new innovation vector for you, but is, I think, something well worth thinking about and maybe bringing into your own strategic thinking. It definitely gave me pause to think about things like, if you're paying for something, maybe that payment is going to be the most effective marketing information in the future. Well, that's all. It's a short credit shift this week with just me chatting to you. Keep your eye out for the credit shift interview, which should be dropping into your channel over the next week or two. Some very interesting conversations about how to adopt AI by some really interesting leading players coming up. And I look forward to maybe seeing you drop over to the Webio.com website, checking out all the news and the new products that we are launching in this area. That's it. Thank you very much.